Hello, everybody. My name is Rupam Deb, and I'm the co-founder of MoneyWiseSmart. On behalf of the MoneyWiseSmart team, I extend a very warm welcome to all of you to this session. Our topic today is innovative strategies to generate cash flows when you need them the most. I know it's quite a mouthful, but I could not figure out a way to shorten it and convey what we are going to do today. So I'm very excited to conduct this session, and the next couple of hours are going to be absolutely packed with value. Now, today we are going to discuss some very interesting option strategies, which are not about option trading, but our strategies cater to the long-term investor. So, innovative option strategies to generate cash flows when we need them the most. So this is our agenda. We are going to recap some of the fundamental concepts, but we are going to just speed through them, okay, like a bullet train, because, as everybody is familiar with what options are. And then we are going to talk about some option secrets to avoid losing money in the long run. We are going to talk about the surest way to get very wealthy over time, but it's unfortunately the slowest way. Nothing that we do here in MWS is about, quick wins, overnight riches, because we don't believe that's possible. Then we are going to dive into a case study discussing a situation where I'm very low on cash, and let's say there's a massive market correction and there are lots of undervalued opportunities. So how do I generate cash flow to fund these abundant undervalued opportunities? And then I'm going to discuss how you can take your option journey forward. So with that, let's dive in. So this is our team. My partner, Fan Liang Chia, he and I co-founded this company, and Sean is our head of marketing. Now, options are very powerful instruments, but unfortunately, most people who use options use them to speculate. In fact, you'll find that 99% of the people use options to speculate. Options are leveraged instruments, so when we luckily end up on the right side of the trade, it can be very profitable. But when we end up on the wrong side, it can hurt us badly. And as we will soon see, most people end up losing money with options in the long run. Let me repeat that. Most people end up losing money with options in the long run because they do not understand the fundamental principles of risk management. Now, in MWS, we do not use options to speculate or trade, and that is how MWS is very unique. But we use options to generate cash flows for us in a risk-managed way when we need the cash the most. And we use a concept that, as you'll soon see, which we have learned from none other than Warren Buffett. Now, sometime back, I went and put up this poll on one of these large Facebook groups. It's one of these option groups. Probably is the largest FB group that exists. I asked a very simple question. Since you started options trading, cumulatively, have you made money or have you lost money? Now, other than the 41% who claim that they made money, we can safely say that the balance have lost money. I mean, they have responded in different ways, but most people were at least honest. They said lost money, but hoping that will change. So on the same day, later that day, what I did was I put up a trick poll, and instead of asking this question directly, I went and put up this question: that if we ask each member here, and then I asked the question that I had put up in the previous poll, since you started options trading cumulatively, have you lost money or made money? What do you think the majority will say? And there comes out the real truth. 47% say that majority lost money, but they will say that they have made money. So you can clearly see that a large majority of this 41% who claim that they made money actually lost money. And there have been lots of studies. My sense is that over 90%, if not higher, of the people who trade options, they end up losing money. And there might be lucky streaks from time to time, but in the long run, unfortunately, that's the case. Now, we will soon see why that is the case. Now, you all are familiar with the structure of an option contract. So, you know what? I'm not going to waste any time on these. So you all know these stuff. I'm just going to, glide through the slides to see if there is anything that I should pause to talk about. You know what an option premium is, a call option, a put option, price of an option. Okay, now this is a concept. While all of you understand this, but it's good to reinforce that the market price of an option should always be greater than or equal to, at least equal to, the benefit the owner can get by exercising the option, which is basically the intrinsic value of the option. Now, if that is not the case, then it will be suboptimal for the owner to accept the market price. Now, I, at this point of time, for people who have attended my session, know that there is a favorite example that I always give, and, even risking repetition, I'll again give that example. Let's say I have a used wallet, an old wallet, which now I don't need anymore, and I just want to sell it off on one of these, second-hand marketplaces. Now, if I put it up for sale, finally, I can ask for a price, but what I will get, that's anybody's guess, because, it's a very old wallet. Maybe I'll get $5 or $10, who knows? But if I now put $100 bill inside the wallet, and then if I put it up for sale, and if I declare that, there's a $100 bill inside the wallet, then it would just not make sense for me to accept any price that's less than $100. So in this case, the $100 becomes the intrinsic value of the wallet. So, that's pretty straightforward. So the option premium that someone pays for an option has two components, the intrinsic value and the time value, or the extrinsic value. Now, the intrinsic value of an option, we all know, for a call option is the share price minus the strike price. Some calculations here, you all are very familiar with this. The extrinsic value of the option is the portion of the market price of the option that exceeds the intrinsic value. The extrinsic value is also known as the time value. So here, again, I've showed the calculation. You all are familiar with this. The interesting thing about extrinsic value, which we use a lot, is that it decays over time. So none of you are beginners, but I'm sure you will appreciate that here there is absolutely no speculation. If we can master a strategy to separate out the intrinsic value and sell only this time value, and every morning as the sun comes up, this time value is guaranteed to keep going down. So eventually it will go to zero by the time the option expires. So, obviously that's very cool, and I can guess that some of you would already be practicing doing this, but then we will look at what are the risks of doing this and how we can mitigate those risks. Now, I'm sure you're familiar with the option payoff diagrams as well. So here, this is the stock chart. Let's say the stock price is at 32. If I buy a call option, the strike of which is 38, and if I pay $2 for the option, effectively my total premium would be $200, because here, let's assume the multiplier is 100. It's not necessarily always 100. There are options where the multipliers are different, like options listed in Europe and Hong Kong. But let's say in this case the multiplier is 100. So the maximum loss for me, even if this company goes bankrupt and the stock goes to zero, is $200. However, the break-even point will be $40, because I have paid $2 for the option, $2 per share. So I have to recoup that, and above that, it's the profit zone, and that profit is unlimited. for a call option. That is, if I'm buying the call option, or in other words, if I'm long the call option. Now, this is how the payoff diagram of a call option compares with the payoff diagram of a stock. So when you're buying the stock, the payoff diagram is just a straight line. So if you have bought the stock at this point, the stock price goes up, I'm in the profit zone. If the stock price goes down, I'm in the loss zone. But in case of a call option, the long call option, the loss zone is limited, whereas the profit zone is unlimited. So above this break-even point, I enjoy the same upside without really having a massive downside. But then let's see if that's the case. Then why would people just not keep buying call options? I mean, it's unfortunately, even that does not work, and we will see why. I mean, it can work if someone is lucky from time to time, but as a strategy, it's difficult to make money that way. Now, that brings me to this story, which earlier today I had shared on our group. So I have this good friend who in 2022, around October, this is the Meta stock chart. And, most of you would probably know that the Meta share price had absolutely crashed, and it had fallen below 100. At that point of time, on the 28th of October, this friend, he had the foresight and, in brackets, luck of buying a bunch of leaps calls expiring in January 2024. That is a couple of months from now. And he bought the 100 strike call, and he paid just below $25 per contract. So his total investment was about 24,457. That's including the commission. And fast forward 1 year from now, that is on the 20. I think this picture is from the 26th of October. That is just 26th of October. That's what this says, just last week. And I had been because I exactly knew his position, I also knew that he would be sitting on a massive amount of unrealized gain. So he was absolutely over the moon, and he called me to inform me that he exited this position. I asked him, how did you exit? He said, I sold the position, and I made and he sold the position at bid 187.7. So whatever he purchased for 24.46 plus a bit of commission, he sold for 187.75. So that's like a massive jump. So I congratulated him, but then I broke the bad news to him, and I informed him that you have left about $600 on the table, and he was completely surprised by that. He said, so I in fact wanted to pull his leg. I told him, but you have made so much money, so why would you care? But he said, of course I care, and $600 is not a small amount of money. So anyway, we'll take a break from this story, and later I will discuss why I said he left the $600 and how he could have avoided it. But that discussion will only be targeted towards the people who stay till the end. So that's and people who show their commitment, that they're really serious about learning options the right way. So now a payoff diagram of a long put is exactly a vertical mirror of the payoff diagram of a call, where if the stock goes up, your maximum loss is capped at whatever premium you paid, but on the downside, your gains keep increasing. Of course, in case of a long put, the maximum gain is if the stock goes to zero, because the stock price can't go below zero. Now, this brings me to another story. This is the story of a trader. Let's call him Peter here. Now, you would remember a couple of years back, there was this massive craziness going on with this GameStop stock, right? I'm sure you would have you would be familiar. So some retail traders, or more so speculators, they were pushing up the price, and some hedge funds were who shorted the stock were absolutely getting decimated. And this Reddit group, Wall Street Bets, they were kind of trying to come together and literally declare a revolution on this. And then after some time, as one would guess, the GameStop stock started crashing from its ridiculous highs. So this guy, Peter, he went and purchased a bunch of put options. And from the time he purchased the put options, the share price almost halved. So you can imagine how lucky he got. So who thinks he made a lot of money? If you think he made a lot of money, type yes. And if you think he might not have made a lot of money, or he did not make a lot of money, type no. Let's see who thinks. I mean, I'm giving you this information that since the time Peter bought his put options, the share price of GameStop literally halved, literally crashed and became half of that. Okay, Kang Yao says depends on the premium paid, not as much. Okay, all right. So we will also come back to this story. I love keeping these stories dangling, but don't worry, I won't forget. I'll finish the story once. No, JC, the strike can be anything. Let's say, I mean, I'm giving you the information that he had a way out of the money put option, and the time when I'm saying the stock price halved, still his expiry was further away. Okay, let's move on. I'll come back to the story once we cover a couple of more concepts. Now, this is the vertical mirror image of a long put. Here, if I sell a put, that is, if I'm short put, if I've shorted a put, then this will be the payoff diagram. That is, my maximum gain will be the amount of premium that I bring in by selling the put, but my loss, if the stock price goes below the break even, then I will have an unrealized loss. Now, this is not necessarily a bad strategy. I mean, you'll soon see that we use this strategy a lot. But yeah, if someone is just speculating with this, this can really hurt if suddenly the stock price drops. Again, vertical mirror image, payoff diagram of selling a call. Selling a naked call is a really, really risky idea. It's a really bad idea because here your downside is unlimited. I mean, if this stock ends up breaching the strike and ends up becoming a multi-bagger, I mean, like, for example, what happened to GameStop when that craziness was going on, anyone who has shorted a call, just like Melvin Capital, those hedge funds got killed. Similarly, a person who has shorted a call can also get killed. Now, why most traders don't end up making money in the long run? Now, there's a good reason for that. Now, this is the typical equity chart of an option buyer, someone who only buys options. Now, his or her equity curve looks like this. There will be sudden jumps in the value of the equity when I mean, out of pure luck, the stock could be moving in the direction. But when that's not happening, the time value that we talked about earlier keeps decaying, and the value of the option keeps getting eroded. Of course, I mean, there will be from time to time, this person can be lucky when the stock again moves in his or her direction, but then it's a very, very difficult strategy to sustainably make money on, and to make this strategy repeatable. And anything that is not repeatable is basically gambling, it is not a good strategy. Hoping and praying is never a good sustainable strategy in anything that you do. Now, markets like these can be an absolute deathbed for long options, but this is where option sellers, they have a ball. Imagine selling short puts, somehow you select strikes which are below the range of where your stock is, or selling calls above the range. They can end up making money for quite some time, and as long as the stock price stays above the strike price, the option seller will make money till the time something like this happens, where their face can be ripped off if they have sold naked puts without keeping capital aside. Similarly, a call option seller, a naked call option seller will have a ball as long as the market is like this, but there is no guarantee, right? I mean, who has a crystal ball to predict where the market is going to be? And then if something like this happens, then again their faces will get ripped off. And we can see this from the payoff diagram of the call option. So when neither long or short puts or calls seem to be working, what do the typical traders do? That's when the discovery of credit spreads happen. So what are credit spreads? Again, I'm sure most of you know that there, let's say you're selling a short put, but instead of leaving it naked, you go and buy a long put at a strike which is slightly below the short put. So that if something like this happens, then yeah, the short put will lose money, but the long puts will start gaining, and your exposure is just the strike difference between these two options, the short and the long options. So in case of a credit spread, this is how the payoff diagram will look like. You see, you have just truncated the loss zone. So in this particular example, while your maximum gain still stays at 200, your maximum loss is capped at 1800. Now, typically, a typical credit spread would have a probability of profit that is very high. Now, let's say if this is the information I give to you, who thinks this credit spread would be an attractive credit spread? You have an 80% probability of making a profit. So would you think this is a reasonably safe position to take? Type yes or type safe if you think this is reasonably safe, and who thinks this is unsafe? Type unsafe. Let's see. Okay, unsafe. Most of you think it's unsafe. Okay. All right. So that's actually the correct answer. And why is it unsafe? It's unsafe. Can anyone venture a guess why it's unsafe? Anyone? Why is it unsafe? Absolutely, Aman is absolutely right. The expected value. So if you do this credit spread 1,000 times, you will have, I mean, this is what the probability say. It might be slightly here and there, but longer you do this, I mean, out of 1,000, you'll have about 800 winning trades where you'll make $160,000. But the 200 losing trades will cost you $360,000. So your expected profit from these 100 trades is actually a loss of $200,000. So the very high probability of winning is often very seductive, but the result of not understanding expected returns, as Aman mentioned here, and Jason has actually done the calculation, the result of not understanding expected returns can be disastrous in the long run. Unfortunately, I mean, I can see you guys are fairly advanced. So you understand this, but unfortunately, most option traders, they do not understand this. They just focus on the probability of the gains. Now, the problem is it doesn't matter what happens in one trade or 5 trades or even 10 trades. What really matters is what happens over the long run. And as far as we are concerned, the long run is over our lifetime. I mean, nothing short of that really matters. I mean, imagine there is no greatness, when I turn 70 or 75 or 80, there is absolutely no greatness in me saying that, oh, you know what, I was a great investor from the age of 35 to 45 or 35 to 55. If after that I end up giving back everything, then there is absolutely no greatness. Now, who all here have watched this movie? Type yes if you have watched this movie. It's called Dumb Money. Today we have a lot of discussions on GameStop. Anyone? No one has watched this movie? Oh, that's interesting. In fact, when I saw this movie come out, I was very interested in watching this movie. Anyway, the good news for you is you haven't missed much. In fact, this movie is about that GameStop saga, and I actually think it's a very dumb movie. Why it's a dumb movie? Because at the end of the movie, they painted, I mean, all these guys, the guy with the green shirt on the left, he's the hedge fund guy. He acted as the hedge fund guy who had shorted GameStop when that madness was going on. And, as you can see from his face, he was having a nightmarish time because GameStop kept rising every day. And all these other people, this guy in the sunglasses, he's the guy who was calling and kind of rallying the forces, telling everybody that he's long GameStop, and everybody else. I mean, he was on Reddit and he would do live streaming, and everybody would listen to him. This lady here, a nurse, deep in debt, but they were all listening to him and they were holding on to GameStop. And the movie ended at a point where all these small guys, the retail traders or speculators, they were kind of shown to be heroes because the movie ended somewhere here when GameStop was somewhere here. So there were captions like, okay, this person made $100,000. This person made, $160,000. But in reality, all they were doing was absolutely stupid speculation. And finally, Roman has watched the movie. And finally, most of them obviously have, given back everything and, have, I would suspect they were even worse off from where they started. I mean, it never ends well. As you can see from this particular post, which I picked up again from another options group, just spend time in just reading these highlighted parts while I take a sip of water. So I will take advantage, put up stuff and ask you to read when I can take my water breaks. So as you can see, this guy is deep in debt, have lost like huge amounts of money trading options. He just lost 45K in a 170K account, had few dozen naked straddles. So basically, I don't know, it's a he or a she, but this person clearly is absolutely clueless about what he's doing. And, by the way, I mean, if I'm using he, that doesn't mean that I'm referring to, I mean, it's just a shortcut. Please excuse me, because it's shorter than saying he or she. So he clearly has no clue what he's doing, and the only thing I think I would give him credit for is at least at least he is open about it. He's not pretending. He's definitely not one of those 41% who is actually losing money, but is claiming that he's earning money. But clearly, this is not the way to what this person is doing is just gambling. Now, sometimes it can end very, very badly. I don't know if any of you know who this kid is. A very sad story. It's literally a kid, Alex Kearns. In 2020, he was incorrectly assigned on, I think, some of his naked options by Robinhood. He obviously didn't have a clue of what happened. He suddenly saw his account had a huge debit balance and he took his life. I mean, my heart bleeds when, things like, I get to hear things like this. And this is the ultimate price of ignorance. I mean, and doing something, basically playing with fire. I mean, doing something without knowing what you're doing. Now, how do we do it differently? So, since we talked about GameStop in the past, I'm going to give you an example of how we use options differently. Now, the strategies are same. I mean, many of you would be using them, but we go a bit deeper. And here is an example. So, when GameStop was at about $70, and the markets were going absolutely berserk, we realized that the implied volatilities of the options are ridiculously high. You see, the implied volatility was 160%. So we went and sold a bunch of $2 strike puts. What does selling a $2 strike put do? It basically obligates us to buy GameStop at $2 when the share price was $77. If the share price comes down, below $2 by the expiry, and these options were expiring in 2 years. So we sold a bunch of it, 583 contracts, and we brought in a premium of 62 cents, so which translates into a cash inflow of over $36,000. Okay, this is the cash that we brought in at the time when we sold the options. Now, were we speculating that, were we sitting and praying that, oh, the GameStop share should not come down below $2? No. In fact, I could not care less. I do not think GameStop is a company that I would even come close to. I have absolutely no interest in wanting to own GameStop. I think the markets were going crazy for whatever reason. Both the people who were buying it as well as the people who were shorting it were being absolute idiots. But what we just could not ignore was the elevated implied volatility. So let's analyze this position, why we did it. Now, the max risk, our max risk, apparently, as reflected by this platform that we use, is $1.38 per contract, which is $2, which is a strike price. And if GameStop goes to zero, then we are obligated to still buy GameStop for $2, right? So $2 is a risk, but we have brought in 62 cents of premium. So our max risk is $1.38. But is it the max risk? Let's dig deeper. Now, we don't just go and sell an option based on the price action. Before we did this, we read the GameStop documents extensively. We reviewed their balance sheet. We studied their annual report, their income statement, and what we realized is that GameStop. See, we are fundamental investors. Okay, we are not speculators. We are not traders. We use options, but fundamentally, we are long-term investors, value investors. So we realized that GameStop has net cash, that is, even after paying off all their liabilities, of 88 cents per share, which means that our actual worst case risk was actually 50 cents per share. It was not $1.38. So that translates into 29,150. So now think about it. I have brought in this $36,000 right away. The moment I sold it, I had $36,000 hit my account. And my worst case risk will happen sometime in the future. Now, all I need to do is I need to invest this 62 cents or this 36,146 cents just at $8 per annum for a period of 8 years to come out even. And or if I get a slightly higher return, let's say if I manage to get a 13% return, I mean, these are just random numbers I plot, then I would need to invest this $36,100 at this rate of return only for 5 years to come out even. And I'm very confident of being able to achieve this because our long-term track record is significantly higher than this. In fact, I'll show you later that we have, over a fairly long period of time, comfortably beaten the S&P 500 or any other benchmark index. So this is how we think of this particular strategy, that for us, more than bothering about where the GameStop stock will be, in fact, I really couldn't care less where the GameStop, in fact, frankly speaking, I don't even know where the GameStop stock ended, because for me, it was a no-brainer that I'm bringing in $36,000 today, and I have time to invest that. Even if the worst case scenario hits, all I need to do is invest that $36,000 for a few years, and definitely not in GameStop. It will be in, one of the high quality businesses, and we will come out even. So who thinks that this can be a cool way to think of the option cash flows? If you think it's a cool strategy, if you like it, type cool. If you didn't like it, then it's absolutely fine. Let's see if anyone thinks this is cool. Okay, at least 2 people found it cool. All right, so let's move on. Now, finally, this is what happened to the position. And as I said, I have no clue what finally happened to the GameStop. I mean, I know where it is now, but eventually, whatever we sold for 62 cents, we bought back 28 contracts for 32 cents, and the balance 555 contracts we bought back for 17 cents as the implied volatility came down. And finally, the position ended up in a $25,000 profit. So we were quite happy with it. And by the way, some of our subscribers followed exactly. I mean, this was by no means a core position, but I know subscribers who took a much larger position following exactly the same philosophy, and ended up making a few $100,000 in this position, a very similar position. In fact, at that point of time, we were sharing. That's also right. I mean, this all happened within a 4-month period. So from October to February. Sorry, this date, actually, it's my mistake. The date is not 2021. This date should be 2022, or is it from 2020 to 2021? Either of those. But yeah, it happened within a 4-month period, $25,000 gain. So how to build a winning system? Kangyo says, why do you just sell 583 contracts instead of more? Why close the position? Okay, we'll take up those questions later. So how to build a winning system? Now, do you want to know the surest way to build wealth over the long term? the surest way to build wealth over the long term is owning a high quality business, is basically a compounder over a long period of time. Nothing beats this. If you look around, I mean, I'm sure you know lots of traders, but if you try to find a successful trader who has been doing speculative kind of trades with options, yeah, from time to time you'll hear of people making money. People make money over short periods of time, but if you want to look for someone who has been consistently making large amounts of money over, let's say, 20-30 years, maybe worth over $100 million, you will find a lot of long-term investors in that category, but you won't come across too many traders who can claim to be in that category. Now you might say, but isn't hindsight 2020? How would you know? I mean, that a stock will go up. Well, I mean, is it really? I mean, as I said, we are fundamental investors, and that stock price is basically, I mean, as some of you would have guessed, is Apple. Now, I don't think it needed a rocket science if someone really looked at the kind of returns Apple generated over the years and how consistent their returns were, or if someone looked at how consistently they maintained the margin. I mean, as long as someone understands how to read financial statements, it's really not a rocket science. And I mean, we have researched Apple. In fact, I even shared a conversation on our Facebook group, a conversation that I had with a fund manager friend, pointing out how cheap Apple was, I think somewhere in 2016 or 2017. I mean, it's a different matter that, at that point of time, I didn't take a large position because I didn't have liquidity, but it was really a no-brainer. But then, do stocks go up smoothly? No, they don't. I mean, there are these scary periods, and these drops are very significant drops, which, now we are looking at the big picture, so we may not appreciate it, but in many cases, these drops are more than 50% drops. But instead of looking at these periods as scary, what if we change our perspective and think of these periods as opportunities to use option strategies to fund the purchases of slices of a high quality business at a discount? So how do we do that? And that's where the expertise in using options from the perspective of a long-term business owner as opposed to a speculator comes handy. Now, using options, we can help to generate cash flows to buy the business at these discounted prices to the intrinsic value. Here, I have just drawn an approximate line which depicts the intrinsic value of the business. So while we are at it, we like to stay focused on the operating business to understand how the business is compounding, instead of just staying focused on the stock price. And we like to focus on how the business is compounding its intrinsic value over time, as opposed to the short-term fluctuations in stock price and all the associated noise. Now, the problem is, temperamentally, it's very difficult to do because of something that's called availability bias. Now, the stock price and all the other associated noise is more easily visible as compared to the operating metrics of the business, because the stock price is at our fingertips, right? Whereas to really go and find out the operating metrics, I mean, we have to do some work, and most people are not happy putting in that work of going, reading the annual reports, looking at the financial statements, listening to the earnings calls. So our brains are wired to couple our mental well-being with the fluctuations of the stock price, as opposed to the gradual growth in intrinsic value of the business. And when the stock price drops, we start panicking. And when the stock price goes up, I mean, we start feeling great. But in reality, it should be exactly the opposite. So this is how we use, this is how we think. So we like to buy a business like this at or below its intrinsic value. So when the stock price is above its intrinsic value, and intrinsic value is an approximate measure. We have our ways of calculating the intrinsic value. So when the stock price is above, we go and sell puts either at or below the intrinsic value. We choose those strikes. And most importantly, we keep the capital aside. So unlike a typical option seller who would sell a naked put and then hope and pray that the stock price doesn't come down and have all kinds of stop losses and all those things, we actually hope and pray that the stock price comes down and we get assigned, because that is our main objective. Our main objective is to buy a high quality business at an attractive price. And sometimes the puts get assigned, we are very happy, but when the puts don't get assigned, at least we are generating a return on the cash, and we have our ways of benchmarking that yield. Typically, we look for a certain yield, and what we typically do is, take a portion of that premium, the premium cash flow that we have brought in, and we also position ourselves to benefit from the upside in case the put doesn't get assigned and the stock price runs away. So we would typically buy, a fewer number of call options to capture the upside, and we have very specific calculations to calculate our returns. So in between the strike of the call and the short put, we ensure that we have a profit zone. Of course, if the stock price moves up, our calls become profitable, the puts expire worthless, and if the stock price moves down, the calls might expire worthless, but we get assigned, and from there onwards, our return depends upon the long-term return that the business is generating. Now, the reality of the world around us is not always a very happy situation. This is the reality of the world around us. Now, few months back, I was doing a webinar, and I used the same slide where I had these 5 pictures, and I had even mentioned there that we are very sure that there will be more such negative events. Only thing is, we don't know what, and we don't know when they will hit us. But now we know what the next one is, and these are events which are completely outside our control. Now, my heart absolutely bleeds for the innocent victims on either side of these conflicts, but unfortunately, events like these are outside our control. And I have a belief that we humans, we are a flawed species. I mean, we are responsible for inflicting the maximum amount of negativity on ourselves, and it's not restricted to a conflict. It can be a trade war, it can be stupid financial risk taking, which brought the entire world to its knees. Now, while those events are outside our control, what is very much in our control is proper financial education. And that is something that all of us owe it to ourselves. Now, when events like that happen, there's something called the VIX index, which I'm pretty sure most of you would be familiar with, the fear index. So that typically shoots up. Now, it's unfortunate that these are the times which are also very ripe for taking advantage of the markets. So again, most of you know what an implied volatility is. So these are also the times when the implied volatility shoot up. Now, you remember I was telling you about the story of Peter, that trader who ended up buying a bunch of put options. Now, he ended up buying a way out of money, that is a $5 strike put option. But you won't believe it, that he paid $7 to buy those put options. So that was the craziness that was going on in the market. Now, anyone who is familiar with options would know that the maximum amount you can make by buying a $5 put option is going to be $5, provided someone, you get to buy that option free of cost. In reality, that does not happen. You have to pay a premium to buy that option. And the maximum amount you will make is if the company stock goes to zero, then you will make $5 minus that premium. But GameStop put options, $5 strike put options, the way the bid ask spread was during that time was trading for $7, the ask price. And that is what our friend Peter had done. So, that tells you the kind of stupidity that many of these novice traders they do without even understanding what they're doing. Now, help me to fill in the blanks. What do you think is the same word that goes in these two blanks? It is wise for investors to be fearful when others are dash, and dash when others are fearful. It's the same word. So let's see who can tell me what that word is. It's quite a well-known. Michelle is right. It's greedy. So it's wise for investors to be fearful when others are greedy, and be greedy when others are fearful. So Warren Buffett belongs in this philosophy, and during times of market panic, this is how the various stocks look like. But if someone looks under the bonnet, it might be business as usual for many of these businesses. And it's times like these which actually are the times to take advantage of these opportunities. Now, that reminds me my own story. Now, I had invested, that was a long time back, over 2 decades back, and I was fairly clueless at that point of time. I had invested a bunch of my savings in 2001, and by October 2002, exactly around the time when my eldest son was born, thanks to the dot-com bubble bursting, my portfolio got cut into half, and I was in absolute total panic. I was clueless about the fact that this was literally the best time to buy technology businesses. Of course, the good ones. I mean, not the pet.com and all those stupid businesses, but the high quality tech businesses. I was clueless about analyzing a business, and the only thing I knew existed was the stock price, which I was watching day in and day out. So I made the most common mistake that many inexperienced investors make. And what do you think? What do you think I did? I sold, putting my family in and that time, I didn't have much money, a young family, putting my family in a very difficult situation. Time of course flies. The same son, he just finished his national service and joined university, and he's an investor himself. And fortunately, he has a much better temperament than what I used to have when I was younger. And of course, he has the advantage of starting early, and he has many decades of compounding ahead of him. So that's the good thing. Now, a situation like that would have been scary. These would have been scary situations without any cash flows to take advantage of those corrections. And if I'm forced to sell my shares during these drawdowns because of leverage or whatever reason. I mean, ignorance can be a reason, which was the case with me, 2 decades back. Now, in a situation like that, Help me to fill up the blanks. I wish I had more dash to take advantage of these great discounts. What word do you think would fit here? I wish I had more dash to take advantage of these situations. Anyone? Absolutely, Chikyong, you're absolutely right. So what if I taught you how to generate fresh cash flows on an ongoing basis to be able to take full advantage of the amazing deals that Mr. Market keeps offering us from time to time? Now, real wealth is not created by speculating on the direction of short-term share price fluctuations. And when I'm saying real wealth, I'm talking of, let's say, 8-figure, 9-figure, that kind of wealth. It is created by buying high-quality businesses at a discount to its intrinsic value and owning them over a long period of time. So that's how real wealth is created. So let's dig into this case study. But before diving into it, I want to understand, is there anyone who has ever found yourself in the same situation, that the markets have crashed and there are lots of great discounted opportunities available, but you don't have cash to take advantage of these opportunities? Have you ever found yourself in such situation? Anyone? Type me if you have found yourself in such a situation, so that I know that a case study like this can be relevant to the group here. Okay, Michelle says yes, absolutely. Since when is there enough cash? Pragati says yes. Okay, so I guess it would be relevant. So that's where our ATM strategy comes in. And yeah, it's a tongue-in-cheek name, but the ATM actually stands for something, and and we decided to name it the ATM strategy. So our advanced subscribers, our diamond level subscribers, would be able to relate to it. So this strategy is a combination of these two concepts that we discussed about. One is the extrinsic value or the time value of an option decaying with the passage of time, and the fact that the implied volatility of options sometimes shoot up from time to time when there are these negative events, or when the fear in the market is very high. So this strategy also works as a great portfolio hedge for those of you who are, who consider it to be important, but we don't bother about doing any kind of hedging, because we spend our time, our hedge is our understanding of the business. So we think of ourselves as business owners. But nevertheless, now before we jump into the ATM strategy and show you, how we build the concept, who would be interested in knowing our cash flow record following the same strategy? I don't want to be presumptuous, so that's why I will always ask for your feedback. So if you would like to see our actual cash flow records using the same ATM strategy, type CF. CF stands for cash flow. No, yes, please doesn't get you. Type the CF for cash flow. If I see enough interest, then I will happily share with you the actual cash flow records. So we have been, very diligent. And when I say we, it's basically, the family office, which is the parent company of MoneyWiseSmart. So we have been very diligent about keeping our records since 2017 April. That is 6.5 years from now. And earlier we used to practice a lighter version of the ATM strategy. So our cash flow started with a few $1,000s every month, and you can see as time progresses, they have been growing. And then in 2022, when we went full throttle, and that's what several of our subscribers did. I mean, our cash flows also exploded. And the best part of the strategy is, as you can see, I mean, there are months we have brought in, close to $500,000 of cash flow. Last few months, we have been consistently bringing in more than $100,000 of cash flow. Now, we actually call this a float. Many of our subscribers have started practicing the strategy. The beauty of this strategy is that the valve is in our hands, the lever is in our hands, and depending upon certain conditions, we can decide. I can literally go and decide that, you know what, this month I want to bring in $200,000 or $300,000 of cash flow. And I would do that if I see great opportunities in the market to deploy that cash. Otherwise, I'll be happily waiting. So we sometimes like to step back and look at the big picture, and this picture gives us a lot of happiness because this shows us how over the months our cash flows have gradually exploded, and that's exactly what we had anticipated when we conceptualized this strategy. As you can see from this, and I'm sure you would have realized by now that we absolutely love these exponential graphs, pointing upwards, and we can reasonably expect our cash flows to be significantly higher 5, 10, 15, 20 years down the line if we stayed disciplined about this strategy, and we don't compromise on the risks. And as you can see, it's not steady. I mean, it's fairly lumpy. There will be times when few months after we had a $450,000 month, we had a $5,000 month back to, but it's completely in our hands. Now, the best part of this strategy is twofold. One is it can be done with very small account sizes too. Now, I use one instrument, which is the high-priced option that is listed on the CBOE, Chicago Board of Options Exchange. But they also have instruments which are 1/10 of the size, which many of our subscribers with smaller accounts use. And we also have options listed in other exchanges around the world, like Eurostox or Japan. Even those options are equally suitable for these strategy, and especially keeping the time zones in mind, because what I practice, I sometimes have to get up fairly early in the morning at the time of market close Chicago, but gradually I'm shifting more to the European time when in fact after some time, maybe it'll be before the end of this webinar, if that happens, I'll actually show you some of the orders, and you'll see how simple and elegant the strategy is. So yeah, very flexible. And the other good part is this strategy takes less than 15 minutes a week if you're using weekly options to execute. If you're using monthly options, it would take less than 15 minutes a month. Of course, I mean, I use daily options, but then, I don't spend more than literally 15 minutes every day, or, whenever I have to put in. Now, the question is, what do we do with this cash? Bringing in the cash is great, but what do we do with this cash? This is what we do with this cash. I mean, we look for opportunities when companies that we have researched. This is Meta, by the way. I tend to use sometimes the old ticker. So, like, for example, at that point of time, we were researching Meta. And by the way, we don't just blindly go and buy the companies. We have a platform called the Multi-Bagger Research Series, where, in fact, some of you here are already subscribers, where we do extensive deep dive research. I mean, the kind of research you'll hardly find anywhere. We literally take many months to research businesses. So as you can see, this was the time Meta stock price kept falling and we kept buying because we had the cash flows to generate. And February itself was a big month. We were, because the volatility was quite high, VIX was elevated, and we just kept buying Meta. And then as the share price fell below 200, rather than panicking, we kept buying more. We increased our purchases. And I'm sure all of you know that this would have turned out extremely well for us. I mean, now Meta is somewhere around $315. And this is like literally just slightly more than a year back. And then around September, we were busy buying Adobe and Google, that is Alphabet, below $100. Adobe at less than $300, and right now it's close to $550, and that's just about a year. And we could do this simply because when the stock prices crash, we look at that as a positive. I mean, we actually celebrate when the stock prices crash, because that is when we increase the cash flow tap, and it allows us to buy these high quality businesses. And each of these businesses are very high quality. Some of you who are based in India would be very familiar with HDFC Bank. HDB is basically HDFC Bank area that is listed in the NYSE. I mean, we researched HDFC Bank, but we use HDB because most of our subscribers are outside India. But again, I consider it to be probably the best bank in the world, if not one of the. And many of you from India will probably agree with me. So what about the excess cash? Because not always, like for example, in 2023. We barely bought anything because we are not finding opportunities which are that attractively priced. So when we are in a situation like this, we park the excess cash in US Treasuries, which are basically cash equivalent. And these days, thanks to the interest rates, I mean, you can get around 5.5% yield on your cash just by literally parking it in the treasuries. Now, I have highlighted this row on the 10th of October. You can see on this date, if I decided to park some cash in some short-term treasuries, I would have got about 5.6%. But instead of doing that, we use another option strategy, which is again a fairly advanced strategy, which we teach our advanced members, the diamond members. Using which on the same day, that is on the 10th of March, I invested about $209,000. This was just excess cash. I had nothing to buy, so I, rather than just leaving it, I parked it in this particular strategy, and it had a guaranteed maturity proceeds of $214,000 on 15th of March. Now, that is exactly equivalent to a risk-free treasury bill offering an even higher yield than we had seen 5.6%, right? That the treasury was offering on that day. I got a yield of 5.9% from this. And if you want, you can actually, take a screenshot and do the calculation yourself. For those of you who are familiar, how to calculate the XIRR or IRR, and you'll see this. This is a very, very powerful strategy which we teach our subscribers. Very easy to implement. And this is irrespective of where SPX ends by 15th of March. I mean, I really don't care. It can go to 10,000 or 2,000 for all I care. My return of 5.9% is guaranteed here. So what does all these strategies translate into? Now, of course, I mean, you might be thinking that, okay, so you are doing all these strategies, but how has your track record been? I have shown you the track record of the cash, but the cash comes with some distant float liabilities. But if I look at, I recently pulled out our track record from Interactive Brokers, and you can see, I mean, this is since 2018 when we started using Interactive Brokers for most of these strategies. So we have been comfortably beating the SPX. Now, that doesn't mean we do not have drawdowns. There are times when we have drawdowns, but these are actually the times we look forward to, because if you can intuitively understand from our strategies, these are the times when our cash flows shoot up and we get to buy these discounted stocks available in the market. This was, I think, the COVID period, right? And that results in, when the markets turn, we accelerate way ahead of SPX, which you can see happening even now. So over the long run, we have comfortably beaten the SPX. Our last quarter, we had a drawdown, but YTD, we are ahead. Last 1 year, our returns are significantly higher than the SPX, and so is over the long run. Now, this cash flow not only funds undervalued stocks, it also pays for our lifestyle. Now, I like backpacking to some of the most remote places on earth, and it is a passion which broadens my mind and helps me to understand the world around us much better. In case of my business partner, Fan Liang, the cash flows allow him to live and work from wherever he feels like. And right now he is in Nepal. And in the last 3 years, he has lived and operated from 6 different countries. You can see Fan Liang in different countries. I mean, he leads a completely nomadic lifestyle. He's a digital nomad in the true sense of the term. And right now he's sitting in Nepal. He's here holding the fort, keeping track of all your questions. Where in Nepal are you, Fan Liang? Is it Pokhara or Kathmandu?
Pokhara now, yeah.
Pokhara, yeah. So he's having fun there, trekking, and these are some of my travel pictures. I love visiting remote places and going and hanging out with locals. I mean, in this picture, I was staying with this family, very loving family. It's in the Himalayan mountains in a small village. Here you can see I was hanging out and taking selfies with these Peruvian kids. And here I was in a small fishing village in Fiji, in a remote island called Gunu in Fiji. And there they have this tradition. So for me to be accepted in the village, I had to sit with the village elders and participate in this drinking ceremony. I absolutely, and this picture is from the world's least visited country. That's Tuvalu. It was just before I was landing. So this is the island on which the capital city is. That's Funafuti. This is somewhere in the mountains. So the ultimate situation one can be in is the combo of financial education, that is proper financial education, a stream of cash flows when you need it the most, and most importantly, freedom. When going on amazing holidays or traveling the world is not a drain on your resources, but the cash pours in even when we are traveling to these interesting places. Now, if you think this is an interesting strategy, and if you are interested in learning the nitty-gritty of this cash flow strategy, let's hear some feedback. Type CF if this still interests you, based on what I have shared so far, so that I know that it's still interesting for you. And again, I mean, I don't want to be presumptuous. I only want to share if I believe that this is still retaining your interest. Okay, all right. So that's enough number of people who say they're interested. Now, expertise in any domain is not achieved overnight. Be it sports or music or let's say if you want to be an expert surgeon, it literally takes decades of deliberate practice. And that is exactly what went in creating our option series program, where we teach our subscribers how to generate cash flows when you need it the most. Now, this is not a program about short-term trading. It has got nothing to do with trading. This is only meant for long-term investors. Now, for those of you who are not interested in hearing about our option series program, the main content part of today's session, the stuff that I wanted to touch upon, it's over. So you absolutely feel free to log out. If you think this is not for you, or long-term investing is not something that you do, I hope you have got some different perspectives which you can go and use, and I hope you found the session useful. But for those who decided to stay on, I'm happy to share with you the details of our option series program. And as you would have realized by now, that the cash flow is something like the oxygen that we breathe, and that is the most important term. So now that enough of you have expressed your interest, so I'll take you through what we teach in our option series program. Now, in option series, we teach how to use option premiums to fund your investment portfolio. We teach strategies to generate cash flows to boost your returns without increasing risk. And managing risk is the most important thing that we focus on. We teach how to position yourself to acquire more shares of your chosen businesses at your desired price, and how to eliminate the risk from your positions, like what I briefly demonstrated to you. And by the way, by now I have not even scratched the surface. I mean, you will soon see that there are large number of strategies that we practice. We teach how to generate an attractive yield on the cash that's waiting to be deployed. And we also teach how to generate explosive profits by risking very little capital. Now, the option series program is built using the expertise that I have gained from different sources and learning from different teachers. For example, these are all the teachers who have taught me at different points of time. Now, many of you would know this gentleman in the middle. Does any of you know? Can I see if any of you can tell us who this person is with the coffee cup? Absolutely right, Nassim Taleb. So I have been very closely following his writing. I have read all his books, and this is a picture when I met him in NUS. He was visiting, and we had a session where he was discussing his way of thinking. This person on the left, this person in the polo shirt, his name is George Fontanelles. He was my first mentor. And he was a Harvard Business School graduate. I used to travel to the US 4 times a year to participate in an elite mastermind. I mean, I invested a lot of money, over $50,000, just to learn from him. And with all the travel and all, I was. Now, the interesting part is, over time, my philosophy has changed. Once I discovered Buffett, and once I discovered this gentleman on the right, who I know some of you know who he is. He's, again, another rock star professor. His name is Professor Bakshi, based in India. One of the smartest investing minds that I have come across. And this is a session which very recently Fan Liang and I, and also if Abhay is here, he was also there. In fact, that's where I met Abhay. Very interesting session. Now, coming back to George. So George gave me the initial grounding in options and taught me how to think first principles. Now, I had made up my mind that if George Fontanilles asks me to stand on one leg while putting in an order, I would do that. That was my level of commitment. And, as I said, I used to travel to meet him often. Unfortunately, during one of his trips to Singapore, we literally had a meeting the previous day, but suddenly he passed away here. And that was very sad. Now, subsequently, this gentleman, Warren Buffett, also massively influenced my thinking. And for a lot of people who do not know this, Warren Buffett actually uses options, but he does not use options to trade. He uses options the way he thinks of an insurance business. He uses options as a source of generating float, and that is exactly what we do. So Warren Buffett talked about this in his 2008 letter, and I have spent extensive amount of time poring over his letters, read each of them multiple times, and several of our advanced strategies, which we build completely bottom up. I mean, you will actually not find those strategies elsewhere, because those are built proprietary, but based and conceptualized based on what we have learned from Buffett, his float generation strategies. So I have been a lifelong learner, as you can see from all these certificates. Attended numerous programs from University of Michigan, Ross School of Business, through Coursera, programs on advanced valuation techniques. I trekked to Columbia Business School to attend their executive program, and you can see from this invoice, for a 3 or 4 day program, they charge $7,200, but I never basically shied away from investing in my own self-education, and complemented that with a massive amount of reading. I mean, I try to emulate Warren Buffett. He reads 6 hours a day and 500 pages a day. I'm not that smarter reader or that faster reader, but I try to, and that's what I do most of my day. I mean, Panliang and I, we basically just sit and read annual reports, read different documents related to companies' earnings. So I try to read, at least a couple of hundred pages every day. And we also do massive amount of back testing. So these are screenshots from the options platform that we use to do all our analysis and back testing. And before we actually practice any of our strategies with real money, we spend literally many months and sometimes years. Like this particular ATM strategy, it took us years to conceptualize, and we only teach what we have extensively tested on our options analysis platform. And I always believed that the best way to learn is to teach. And that is what I have been doing over the past several years. So I have been invited by various universities, various platforms to teach about our investing strategies. These are pictures from some local universities, NTU and SMU, where I have visited a few times as a guest lecturer. This picture is me speaking to our local investor community, part of a group. And, interestingly, everywhere the different stuff that we talked about has played a role in conceptualizing these strategies that we teach. This is, Tiger Brokers, a broker firm. They invited me. They wanted to interview me for the annual day, and they also wanted me to make a presentation on our option strategy. And as you can see from this slide, I'm talking about Warren Buffett's float generation. I mean, because that is what we practice. And this is a recent series, as you can make out from my hair, which has And by the way, I should have told you that the past pictures that you have seen, I mean, that proves that I used to have hair at one point of time, and I'm just lazy to change them. So iFast, many of you would be familiar with iFast. They have their own TV channel, and they invited me to create a 4-part series with them. So it's there. The videos are, I think, there on our Facebook group, or also you can go and check them out on iFast TV. So all this culminated in finally our option series program, which is a program that's hosted on a learning management platform called Teachable. It comprises over 250 videos, and you can see the number of modules. Each module is a different strategy, and it's probably, I wouldn't say probably, I'm very confident that it's the most extensive options program that you will ever come across. And I would actually, throw this as a challenge, because I have extensively looked for several years. I haven't come across anything that is as extensive, but not meant for traders, meant for long-term investors. And this is just, a small snapshot of what we cover in the ATM strategy. There are many more screenshots. I mean, the slide would not fit all the modules. You can see that this strategy itself is a program in itself, which we have been practicing for years.